So I think the investors are generally worried that we're going to see a sort of hawkish spin from Powell today, and I think they might be disappointed in that regard. I think what he's hoping to achieve is really a non-market moving kind of speech, because the Fed are very keen to reiterate their sort of data dependency now. So he doesn't really want to put anything in his speech that will pre-commit to any further rate hikes. So I think it could be a bit of a dull fest, hopefully, from Jackson Hole today.
Okay, so we won't expect much in terms of near-term guidance, but could he address where rates go over the longer term? Looking at the title of the summit this time round, the theme is structural shifts in the global economy.
Yeah, so I think there's been a lot of debate about the kind of R squared, the rate at which policy is neither restrictive or too loose, and whether that has shifted higher in recent times. So essentially, most people sort of assume that it's something around about sort of 2.5%, and maybe there has been some changes in the economy and the sort of global markets recently that might mean that shifted a little bit higher. But I think it's very early to call judgment on that. And regardless of that point, I think it's very clear that rates are in very restrictive territory already, above 5, and you're seeing QT. And when you've seen global central balance sheets shrink in the past, that's generally been a little bit of a negative for kind of risk assets. So for us, we think yields are very attractive at these kind of levels. And ultimately, as growth slows and potential shocks to asset markets come when rates are high, Treasury yields and global government bond yields look pretty attractive to us, and we'd expect them to be lower in 6 and 12 months' time.
Yeah, it is interesting to note how bearish positioning is, though, going into today's Jackson Hole. I was just taking a look at the CFTC data. I want to just turn back to what you were saying about the growth profile of the U.S. economy, because, again, for so long we were talking about this recession that never really appeared. But now it feels as though there are a few cracks that are beginning to appear beneath the surface. To what extent do you think that is going to affect the trajectory of U.S. growth in the coming months?
Yeah, I think you've hit the exact point there, because people have been surprised that we haven't seen more of a negative growth shock to kind of rates being high and the regional banking crisis that we saw earlier in the year. And I think a little bit of patience is warranted. As you rightly point out, the cracks are starting to emerge. The sort of comfort blanket of excess savings that the US consumer had really is disproportionately held in the very high end. And when you look at things like delinquencies on store cards and credit cards, they're starting to creep up, signs that the consumer is really struggling, and volume of retail sales are declining as well. So I think forward looking, we would expect weakness to come through, but ourselves have been surprised by the resilience of the economy to date. But we need to acknowledge that a lot of policy tightening has happened. It's still in the pipeworks. It's not an instantaneous impact. And the longer rates are at these higher levels, the weaker growth should be.